and I am CEO and founder of 1095helpdesk.com. I have a background in human resources, payroll, and benefits. I've also worked on the broker side in addition to doing open enrollments and assisting employees with their benefits on the employer side. And over the last couple of years, I have been assisting employers navigating their ACA responsibilities and reporting requirements. And this webinar that we're going to dive into here is going to focus on the reporting and the 1094C and 1095C forms. If you do have a question, I will be doing a Q&A at the end. You're welcome to type the question in the chat box. If you'd like to keep it private, if you don't want anyone else to see your message, please go ahead and choose my name, Lisa Slook, or the presenter, to send the message to, and then that will be seen only by me. I will go ahead and get started. Oh, maybe. What just happened? Sorry about that. Now I will get started. So the reporting, we're going to talk about the 1094C and 1095C forms. We're going to go through what's new, take a look at the affordability factors, kind of discuss who really needs a form, go over when filing is due, extensions that may be available, the penalties, and then we're going to go through some examples. And then if you have any examples that you want to talk about that are things that are going on in your company, like I don't know what code to use for this employee and this happened throughout the year, please feel free to ask that at the end, and we'll bring up the 1095 form and go through it right on the spot. So the 1094C form, that's the transmittal of your employer information. So you are telling the IRS, here's how many forms I'm sending you with this transmittal, that I'm part of a controlled group or not, that I offered minimum essential coverage to my employees or maybe didn't, that I have X number of employees that are full-time per month, and that are total number of employees, including part-time, variable, seasonal, and full-time throughout the year. Then there's some transition relief we're going to get into, and we're going to take this step by step. So the first, whoops, if you're just joining, please go ahead and mute yourself. We will be muting you as well. It just might take us a couple seconds to get there. So the first part of the 1095C, or excuse me, 1094C Part 1 is the employer information. So if you are part of a controlled group or are under common ownership with any other entity, each of your EINs needs to complete a form. So each entity needs to complete a form. So you may have a sister company or multiple different companies kind of all under your umbrella, and together you may be an applicable large employer, even though a couple of your entities may only have, say, 15 or 20 employees. Whereas a standalone, they wouldn't be an applicable large employer, but together you are all aggregated and counted as one large employer. When you do the reporting, each entity needs to report separately on the 1094C form, and then the 1095Cs for each employee that's part of each entity. So as part of this employer information section, each employee will need to submit a separate form with that employer name on it and that EIN. And please make sure that the name of the employer that you're putting there matches what is set at the IRS. So let's say your company goes by Little Ant, but your designated name that's on file with the IRS is actually Little Ant LLC. That makes a huge difference if you are electronically filing your forms, because the IRS will come back with a mismatch. And it could be, your file could be entirely rejected depending on what the mismatch is. Same holds with a DBA. If you're doing business as, like I'm doing business as 1095helpdesk.com, but my legal entity name is ACA Consulting Group LLC. So if I was filling out this form, I would put ACA Consulting Group LLC, not 1095helpdesk.com. A little bit farther down from those boxes is line 18. So here you enter the number of forms attached to the transmittal. So copies of all of these 1095C forms, as you know, must also be provided to employees. But they need to be sent to the IRS as well, either on paper or electronically. If you're sending it electronically through a software system, they're capturing everything already. But I did have a client last year send just the 1094-C form in without the forms. So we're needing to kind of regroup and get everything back together for the IRS. So make sure that if you're submitting on paper, that you do send all copies of 1095-Cs with it, and that you enter in the total number of forms that you're sending. So line 19 gets a little confusing with the authoritative transmittal. I don't know why they chose that verbiage, but if you're filing more than one 1094-C form and attaching if you're filing only one, 1094-C form, and attaching all of the 1095-C forms that you have to the transmittal, then check that box. You do have the option of filing multiple 1094-C forms, let's say for different divisions. So if you have a large organization, like 1,000 employees, and you want to break it up a little, you can do that by submitting different sections to the IRS. If you have 250 or more 1095-Cs, you must submit electronically. You can still do those in batches if you want to, but if you have 250 or more, you still must file electronically. And whoever's on the line, could you please mute yourself? That would be great. Thank you.
Okay, I just want to make sure what we picked out. My husband's saying that the color is not matching, so I just want to make sure what we picked out.
Okay. So if you, let's say, maybe have a smaller organization where it's under 250 1095-Cs, but so you're going to file on paper, which you have the option of doing. You can always file electronically if you have less than 250 as well. But if you're going to break it up, then you do need a 1094-C for each division. And then on one of those forms, you need to check it as the authoritative transmittal and put all of your data on there. So the total number of forms that you sent from all of those 1094-Cs goes on this form here. For controlled groups, if you are filing one 1094-C for each EIN, you do not submit a separate 1094-C with data that compiles all of your employees, all of your forms, all the numbers of who's full-time versus the total number of employees per month. That doesn't need to happen. You don't have to aggregate all your data that way if you're part of a controlled group. You just have to file one 1094-C for each EIN. So line 20 is in part 2, and this is part of the applicable large employer member information. So if this form is the authoritative transmittal, enter the total number of forms filed from all of your 1094-C forms for a single EIN. So I'm hoping that that makes a little sense. So back here, and I may have misspoke on this right here. So line 18, this total number of forms here is the total number of forms going with this transmittal. If you are breaking it up by divisions and sending multiple 1094-Cs, then you're going to complete the total number of forms sent for your entire organization on line 20. So my apologies for that. If you are part of an aggregated ALE group, so if you're part of that controlled group or common ownership, then you are going to click yes on this box here on the form. And if you're not, then hit no. If you check the no box, then you don't need to complete that section of part 4, which we'll get to in just a minute. Line 22 is a doozy. This is a little bit easier this year than it was last year. But for box A, the qualifying offer method, you must offer employees minimum essential coverage, minimum value, and in addition to their spouse and dependents at a rate that is at or below 9.66% of the mainland federal poverty level divided by 12. So that's about $95.38 per month. So if you charge at or below that, and you're offering a plan to employee spouses and dependents, that's minimum value, minimum essential coverage, you are eligible to use the qualifying offer method, which is also known as Code 1A. So on the 1095-C form, if you've checked this box, you can use Code 1A on line 14. You leave line 15 blank, and you can indicate a code on this line 16, which is a safe harbor, but it's not required. So if you're able to use the qualifying offer method and you've hit that requirement up there of employee, spouse, dependents, and at or below $95.38 per month for the employee-only rate, then you don't need to put anything in line 16. So if someone's covered for all 12 months, they've been with you, they were on the plan all 12 months, all you have to do is put 1A in one box and you are done with that employee. Your reporting just got a whole lot simpler. There is an alternative method for furnishing the information that's on the 1095-C to your employees. It's telling your employees, we have offered you a plan at this rate that's minimum value, minimum essential coverage to yourself, spouse, and dependents. If you can go that route instead of creating a 1095-C for the employees. However, the IRS still needs the landscape version of that 1095-C. So it doesn't make a whole lot of sense to double work yourself with this reporting. So you can just go ahead and complete that 1095-C and make it available to your employees and the IRS. This box C here, Section 4980H transition relief, is still available for 2016 in very limited cases. The information is in the instructions. The IRS has done a decent job of going into it in detail in the instructions for 2016 as to what qualifies and how you go about figuring out if you are eligible for the transition relief. I'm not going to dig into it as it would increase the amount of this webinar probably twofold. Box D is the 98% offer method. So in order to check this box, what you need to do is certify that for each month out of the calendar year, you offered affordable minimum value coverage to at least 98% of your ACA full-time eligible employees and their dependents. So in the last webinar that I did earlier this morning, we went through what an ACA full-time eligible employee is. So to relieve yourself from the penalty, you need to offer it to at least 95% of your ACA full-time eligible employees. To check this box, box D, it's 98%. So some of you might be thinking, well, that's easy. I know we offer it to everybody because we only have full-time employees. Great. Can you prove it? If you're asked to go back and prove it, are you able to produce documents that can say, I offered it to all of these people from this date to this date, so their coverage was from January 1st to December 31st. Or for a new employee, maybe their coverage was from April 1st to December 31st because that's the end of your plan year. You want to be able to prove it. Do you have waivers on file for them if they didn't enroll? Have you audited yourself to make sure you really haven't missed anybody throughout the year? So if you're able to check box D, you have less reporting requirements on the 1094-C form because you don't need to complete Part 3, Column B, which is what we're going to get to in a minute, and that is the total number of full-time employees per month. So speaking of Part 3, in Column A right here, minimum essential coverage offer indicator. What that means is that you're going to tell the IRS, yes, we offered minimum essential coverage to our employees and dependents for the entire 12-month calendar year. You can click this one right here on line 23. If for whatever reason this didn't occur, maybe you bought a business and that company had not been offering benefits because they didn't meet the need. They didn't have 50 or more employees, but as part of your controlled group now, they were offered minimum essential coverage throughout the year. So you do need to report what happened even though they weren't your employee yet. So you can say no for certain months and then click into the yes column when it hits that month that you started to offer the minimum essential coverage. It's not asking for minimum value or affordability. It's just wanting to know when you offered minimum essential coverage to your employees and dependents. So here's that column B, full-time employee count. You don't need to complete this section if you're able to certify that you offered the plan to employees and dependents to at least 98% of your full-time eligible employees. If you aren't quite sure or don't think you can prove it, then you do need to complete each box here for each month out of the year. Rarely is it the same number all 12 months, as you do have some turnover, maybe you have some new full-time employees coming in, some people leaving. If you have a really steady base, you just might be a lucky one that only needs to do one line up there on line 23 to indicate how many full-time employees there were all year. So what is a full-time employee? It is that ACA full-time employee that's not in a limited non-assessment period or waiting period. So if an employee in January was first hired, let's say they were hired in January 2016, you're treating them as a full-time employee, but they're in a waiting period for their benefits. They would not go in column B yet, not until they hit that offer of coverage date. So if it's first of the month following 60 days, so you might be in April 1st for when that employee would show up in column B. They started in January. If an employee maybe worked over 130 hours in a specific month, but they're in an initial measurement period, they still don't go in column B because they're considered as part of a limited non-assessment period because they're in their initial measurement period. Column C is the total employee count. There's a few different dates that you can choose from. Most software companies have already done this for you and have selected the first of the month. So it's a total number of employees employed by you on the first of every single month, including full-time, part-time, seasonal, variable hour employees. So that full-time employee hired in January that was in a limited non-assessment period, we couldn't count in column B. If they were hired on the 1st of January, we're going to count them in column C. If they were hired on January 5th, they're still not part of column C because they were not employed by you on the 1st of the month. Same holds true for someone who terminates. So if we come to February and someone terminated on January 25th, they are going to be part of column C in January, but not part of column C in February because they no longer work for you. So they're not part of your total employee count. Column D there is the aggregated group indicator. If you are part of a common ownership or controlled group, you do want to select the box for every month that applied. So in the example I used a little bit earlier, if you purchased another business throughout the year, you may not have been part of a controlled group until, like, say, May, when that acquisition occurred. So you wouldn't hit the all 12-month box. You would wait until May. That's just an example of that. So column E is if you are using that transition relief, there are certain codes you do need to set in column E, and that's in the instructions. So getting down to part 4, this is where if you, again, are part of a controlled group, and that aggregated ALE, you do want to list all the other names and EINs in this area here. So let's say you have 3 entities. You're reporting on one on this 1094-C form, so that's the first entity, and then you have 2 more. One has 20 employees and the other has 10. On line 36, you're going to put the company that has the 30 employees, the one that has the most, and then you go down from there. So if you have multiple entities, you want to start with the top one that has the most employees and go down from there. So then your next 1094-C form, you're going to have whatever entity you're working on there, and then you're going to place your all other entities below it in part 4. If you're not part of an aggregated ALE, don't worry about it. But again, please do make sure that that name matches what's with the IRS. All of these are scanned into a computer. It's not somebody sitting there going through each individual form and determining if you will be assessed a penalty. It all goes into the computer. It all gets, all this big data comes together from the exchanges, from the health insurance companies, from your information, and then penalty notices start going out. The IRS is expected to start sending those notices this quarter. I say expected because there's so much going on right now in Washington that we're really not sure when that will occur. They have stated for a while now that it is expected to go out this quarter, so be on the lookout for those. Now getting into the 1095-C form, Part 1 is the employee information and employer information. So use the most recent address that you have for the employee, and the employee does not attach this form to their tax return or send it in to anybody. They just hold on to it with their tax documents. And the IRS has updated the form to indicate that. It's right up here. Do not attach to your tax return, keep for your records. And I've been asked, well, why in the heck are we doing this if they don't need to attach it to their tax return? And it does have a lot to do with the individual mandate and individual subsidies. But that's about the only reason why I can think of that they need to have a copy. The employer information is the same that's used on the 1094-C. If you do have a controlled group and you have multiple different entities and you have employees that you share between those entities, like if you have different restaurants and you have serving staff that goes back and forth between the two restaurants, both entities may need to report on a single employee. The instructions do provide additional details and an example because you do need to aggregate the hours worked for those employees and track them as one employee but with hours in both entities to determine their status. So most of the time, someone who's hired as a server is considered a variable hour employee because they're not reasonably expected to work 30 hours a week or more unless that's how that restaurant is classifying that specific position. So they might be a variable hour in both entities. So those hours need to be aggregated together, tracked and measured, and then reported on accordingly. The offer of coverage and who would report on the offer of coverage depends on which entity the employee worked for the most. So let's get into part 2 a little bit. The plan start month that they added to the form here is optional. It's still optional for 2016. You don't have to put it in there. If you have a software system and it doesn't automatically do it for you, don't worry about it. It's okay. You don't need to go back through and edit all the forms. Line 14 here, the offer of coverage. It's really asking, like, what happened to this employee throughout the year? What was the offer of coverage to the employee? When was it offered? Not what did the employee take? Which plan specifically did the employee take? It's what was offered to them. So was the individual employed all 12 months? Was an offer made all 12 months? Like all of those things are pieces that go into this form. As part of your audit file, I would make sure that the paperwork you have, and it indicates how many months of coverage was this employee offered. Were they offered coverage from April to December? Was it January to December? That helps not only show good business practices when you may be audited, but also helps in your reporting, especially if you need to do this by hand. So you need to know, when did the offer of coverage start? So this isn't the date that you give the employee paperwork to sign up for benefits, but this is the date the coverage starts. So if you have a first of the month following 60-day waiting period and someone started like January 12th of 2016, their offer of coverage is going to show in April 1st. If you have a 90-day waiting period and the offer of coverage happens to be like in the middle of the month, let's say the middle of April, you can't put in that the offer of coverage occurred in April because it did not cover every single day of the month. So you don't get credit for April. You would only get credit for May and going forward. So you report the plan that was offered to the employee, not necessarily what the employee elected. So some of the clients I've dealt with have a qualifying plan. So it's minimum value, minimum essential coverage, and it's affordable. And then they have another plan available that's just minimum essential coverage. So what you would put here if that employee went and just chose the minimum essential coverage plan, is this still the plan that you offered them, which is minimum essential coverage, minimum value, and offered to employees, spouses, and dependents. And in that case, that would be code 1E. So common codes that we see on line 14, and line 14 should never be blank. There should always be something in every box for line 14, unless you're using the all 12 months, because all 12 months applies for one code. So if an employee started in March, you're going to show 1H in January, 1H in February, 1H in March, because there's still no offer of coverage. First of the month following 60-day waiting period, you're going to show 1H in April, 1H in May, and then since you offered a plan that was minimum value, minimum essential coverage to employee, spouse, and dependents, you're going to use 1E. If you just offered minimum essential coverage and minimum value to employee only, and you did not offer the ability for spouses and dependents to enroll, it's a totally different code. It would be code 1B as in boy, and all of those codes are listed out in the instructions. Another common code that we see is that 1A code, the qualifying offer. So if you are eligible to use that because your rate that you're charging the employees is $95.38 or less per month, you can use code 1A on those months where it applies up here. And it applies for all 12 months. You just fill out this one box here and you are done with that employee. Super simple. So some new codes that popped up are due to conditional offers made to spouses. So if you have a conditional offer for your employee's spouse and you did not offer coverage to dependents, but you are conditionally offering it to spouses, which I don't even know why that code is there because hopefully no one is doing that at all. But let's say you're offering it to employees and their dependents, but conditionally offering it to the spouse. You're going to use code 1K. So what is a conditional offer? It's subject to one or more reasonable objective conditions. If you have a conditional offer for your employee spouses, be prepared to provide a list of what those conditions are, because the employee spouse may be barred from a subsidy through the exchange, even due to a conditional offer. It gets really complicated on the individual mandate side for a conditional offer, so your employees may be asking you, well, what are the conditions so that we can present it to the exchange? The only example the IRS has given as to what a reasonable objective condition is an offer to cover an employee spouse only if the spouse is not eligible for coverage under Medicare or a group health plan sponsored by another employer. So where I've really seen this in real world practice is that the employer covers 100% of, let's say, employees and their dependent children. They will cover a spouse as long as that spouse does not have coverage elsewhere, and they'll cover them at 100%. So that would be a condition on that offer of coverage to the spouse. Because again, for the mandate, you just need to offer coverage to employees and dependent children. You don't have to offer it to spouses. If you happen to offer it conditionally, your codes are the 1J and the 1K. So line 15, part 2, show me the money. The IRS wants to see the employee-only rate of the lowest cost plan that you offer. So if you offer multiple plans, say 3 plans, you're going to enter the rate of the lowest cost plan that you offer to the employees, and it's the employee's share. So whatever that is per month, if it's $200, $150, $80, you would enter that information here. Again, if you're using code 1A, you leave that section blank. And for non-calendar year plans, if the rate changed during the year, you need to update the form accordingly to show that the rate adjusted in the middle of the year. So let's say you happen to offer minimum essential coverage, minimum value to employee, and at least minimum essential coverage to dependents, but not to spouses. Not at all, not even under a condition. You would be using code 1C on line 14. And then even if the employee rate that you're offering underneath that plan is 0, you still need to enter 0 on line 15. It's a little bit different than the 1A code because you don't have a qualifying offer. So what's new for line 15? Notice 2015-87 is proposed regulations the IRS is asking everyone to follow. There are not final regulations that have been released yet. At this point, I'm not sure that I really expect them to be released. They were suggesting that we'd see final regulations before January 1st. So what that all means is that if you have an employer HRA, not an HSA, but an HRA, those contributions to the HRA may decrease the amount on line 15. So if you as the employer contribute $1,200 a year to the HRA, which is $100 a month, and the plan to the employee is $200 a month, that's that lowest cost share of employee-only coverage is $200. Line 15 is now $100 for that employee. If you have a medical and dependent FSA, you can also decrease that amount shown on line 15 by the amount that you contributed based on a monthly basis to those contribution buckets. Again, this is proposed regulations. It's not mandatory that you follow it. If your plan happens to be unaffordable, so it's not affordable to your employees, let's say it's $300 a month, but you offer this $600 a year towards medical or dependent FSA, that rate is now $250 to that employee. So you can fight it as long as all of these pieces were adopted prior to 12/16/2015. So you can fight a penalty notice in 2016 if you've contributed these amounts. You don't necessarily have to put it on the form, especially if you've already been working on that. And most software systems are not ready to integrate all of these pieces into line 15. Opt-out or cash in lieu credits will increase line 15 if it's been adopted after December 16th, 2015. So if you have in place a program where if an employee waives coverage, that they can pad their paycheck with like an additional $300 a month because they waived coverage, that actually increases line 15, which then makes that plan not affordable to that employee at all, which opens you up for a penalty. And that's if these opt-out or cash in lieu credits were adopted after December 16th, 2015. And again, these are not final regulations. Just letting you know that it's out there because you have a way to fight any penalties if these things apply to you. So line 16 is all about the employee's enrollment and safe harbors. So if an employee is not employed on any day of the calendar month, you're going to use code 2A. So if an employee started in April, their line 16 code will be 2A for January, February, and March. If their employee is in a waiting period, if it's their first month of employment, or if they're an initial measurement or administrative period, then you can use code 2D. When the employee enrolls in coverage, I suggest you use 2C, and if they waive the coverage, you can use a safe harbor code as long as the plan is affordable to the employee. If the plan's not affordable to the employee, line 16 must be left blank. So in a termination month, let's say the offer of coverage for an employee, if they enroll in the benefit plan and terminate on the 10th of the month, they're still covered through the end of the month. If your plan is set up that way, then the termination month will always be either 2C enrolled or whatever waived code you have based on the safe harbor that you've chosen, unless it's not affordable, which it would still be blank. We don't use 2B, B as in boy. The only time you would use 2B is if the plan stops on the last day or they are not covered for the entire month. So if you have a plan where the benefit, if an employee enrolls in it, stops on their last day worked, then you're going to use 2B as in boy in their last month of employment there, regardless of if they enrolled or waived. So for the affordability safe harbor, if you happen to miss enough employees in a month where you did not offer them coverage, so you're outside of that 5% buffer, for your employees, you cannot enter any safe harbor code for any employee for that month. Basically, what the IRS is saying is we want you to do the work for us and tell us that you didn't offer enough people benefits. That's really what they're saying. I don't work for the IRS, so I can say that. That they just want you to really do the work for them on these forms, and they have put this in the 2016 instructions. It was not in the 2015 instructions, but it has shown up in the 2016. So keep in mind that if you did not offer a plan to at least 95% of all eligible employees and their dependents in a certain month, you cannot use a safe harbor code for any month, or for that month for any employee. If you have union employees, there is still the interim relief rule for you, which is code 2E, and you use 2E regardless of if any other code applies after hire or before term date. So I previously mentioned that if when an employee is hired, their first month, you can use 2D as in dog because it is a limited non-assessment period. If you're doing a form for a union employee, that code is 2E. Doesn't matter. It's still 2E. So we just want to make it really easy and go through it. So it is 2E if it's a union employee. Doesn't matter if any other code applies. It's still the same where it's a 1H and 2A if they're not employed by you on any day of those months. So I've talked a lot about the limited non-assessment periods. There are 5 different periods that are considered a limited non-assessment period where you can use code 2D. The most common ones are the first month of employment, during a waiting period for benefits, during an initial measurement period and initial administrative period. All those time frames you can use a code 2D. However, there's always an exception with ACA. So if you happen to miss enrolling an employee on time, you lose the entire 2D protection that you've had going all along. So if you have an initial measurement period of 12 months, that administrative period of 1 month, and you miss that enrollment, since that window is so small there, you just lost that 13 months of protection. And for any of those months where that employee had 130 or more hours of service, it just opened you up for a penalty, the A penalty, which is that 95% marker. So if that happens to enough employees, and for any given month, if you show that you didn't offer coverage to at least 95% or more of your eligible employees, which includes people that were in an initial measurement period and happened to have worked over 130 hours in a month, you now owe a penalty for that month for that person if one employee goes to the exchange and qualifies for a subsidy. So make sure that you offer benefits on time every time, or this will really start adding up. So let's talk about Part 3 a little bit. If you are the plan sponsor, so if you are self-insured, if you're part of a benefit trust or a MIWA, multi-employer welfare arrangement, where you are the plan sponsor, you do need to complete Part 3, which covered individuals. Please make sure that this box right here is checked, because again, this is all scanned by a computer, and they really want this box checked if you're filling out Part 3. Some software companies miss this box, so make sure as you're going through and auditing your forms that it is selected. So the name of covered individuals, their social security number and date of birth will go here. That includes the employee. So the form is all about the employee. You still need to list the employee here if they were covered during any month of the year or all 12 months, and fill out those boxes here. Any dependents also need to be listed, and COBRA coverage needs to be shown down here as well, because you are the plan sponsor. This Part 3 is the same type of thing that health insurance companies do on their B form, the B as in boy. So you are doing 2 different pieces. You're doing the C form and the B form, but it's all together on the C form. So if you have non-employees, like board members or COBRA beneficiaries that aren't employed by you on any day of the year, you still need to complete a form for them. And if there was a part-time or non-employee that was enrolled all 12 months, you need to utilize code 1G in the all 12 months box and still complete part 3, so that you have a lot of additional reporting responsibilities to go through, including TIN solicitations. What do I mean by that? Well, in the previous screen there with a covered individual social security number or date of birth, you can use the date of birth as long as you still solicit for the social security number. You need to show and document that you've been doing this, or it could create a penalty for an incomplete form. So it's detailed in 2015, notice 2015-68. There's an initial solicitation, a second, and a third. And you should mail it out, and you can solicit electronically as well. There are rules associated with that. So the employees that really need a form is any employee that was full-time for any month during the year and is subject to a penalty, including union employees, so make sure you are reporting on them. If you're self-funded, any employee, non-employee, COBRA beneficiary, retiree that's enrolled in your plan needs a form. If you're sending these out electronically, make sure you have consent. That is also part of the instructions. It's within the first couple of pages is how to obtain electronic consent from your employees. And so notice here I didn't put part-time. Part-time employees don't need a form. You don't need a form sent to the IRS. The only time you would need to send a part-time employee would be if they're on your self-funded plan. But if you're fully insured, you do not need to report on an employee that was part-time all year long. So again, over 250 forms, you do need to e-file through what's called the AIR system. This is different than the W-2 system. We created a whole nother system just for these forms. Copies are due to the employees by March 2nd. That has been extended. If you file on paper, it's February 28th. Electronic filing is March 31st. If you need a 30-day extension for IRS, they must be filed through the Form 8809 on or before the due date. There are no other extensions available for employee copies. There's different penalty amounts. Good faith reporting has been extended for 2016. However, good faith reporting doesn't just mean I'm going to slap up codes on a form and send it off. You should really be looking at things and adjusting things from last year if it was being done incorrectly, so that you're showing that good faith and showing that you are updating things and changing things going forward. If you fail to file on time with the IRS, it's $260 per form. If it's found that you failed to provide a copy to the employee, it's $260 per form. So if you are not offering benefits, still file with the IRS and tell them that you didn't offer benefits. So in talking about responsibilities of who is really responsible for getting all this out and applying the employer mandate, it really is the employer. It is the employer shared responsibility. It's all of your information going on these forms. Technology is your friend. Please use it, but also audit that technology. Make sure that what's going into the system is correct, because it's garbage in, garbage out. Make sure that your forms are correct and you see the codes that you should see on your forms. Don't just blanket approve your 1094 and 1095 forms that are generated by your payroll, HRIS, or form generator company that you're using. Review them. Make sure all the data is there and everything's working together. So I'm going to go through some examples quickly here, and then I'll get to some questions. So this is an example of someone who was employed all 12 months. The plan was the same all 12 months, probably because there was a January to December plan year, and the employee enrolled all 12 months. This is all that the employee you need to show for that employee in Part 2 for the 1095C. This is a plan year switch in July where the rate went up. The employee still had that offer all year long. They were still enrolled all year long, but their rate changed, so we can't take use of this all 12 months box. This example is the first of the month following 60-day waiting period with a plan year change in December. The employee was hired in July, and then there's a rate of pay safe harbor used for the affordability factor, and the employee waived in December when the plan year changed. So they're 1H2A, not employed all the way to July, 1H2D, because this is their higher month, waiting period, still no offer of coverage yet, even though we may have given them the paperwork, because the offer doesn't actually start until October. So here's the October rate and information, and the employee enrolled, and then in December, the rate changed, the employee decided to waive. So that's what that translates to. In this example, same hire date, but the employee was missed. So this is what I was talking about, where you lose that protection of all of that 2D code from July, August, September, and then they were never offered in October or November because they were missed, but they were caught in open enrollment, so they were then offered a plan starting December 1st, and so that information is here. So here, there's a plan offered that's not affordable, and the employee was actually hired in 2015. So they're in that waiting period in January, February for the plan, because it's first of the month following 60 days. And then their offer of coverage happened to be minimum value offered to employee and at least minimum essential coverage offered to dependents. No offer was given to a spouse. So it's a code 1C. So see, there's different codes based on your plan information. The employee's monthly share is $400. It's not affordable, so line 16 is blank. They terminated in August. We still don't use 2B as in boy here because if they had enrolled, coverage would have continued through the end of the month, and then they're not employed through the rest of the year. So with this employee, they were terminated back in December. They were in a stability period as a full-time employee. They were rehired March 8th, and they're offered back again April 1st because of that 13-week rule. They were gone for less than 13 weeks, so they're treated as a continuing employee when they come back, offered coverage the first of the month following their rehire date, and then continued on from there. If you're self-insured and this employee enrolled in COBRA for January, February, and March, you'd need to show enrollment for all 12 months for this employee because you were telling the IRS they were enrolled all 12 months. That's part of that individual mandate. Here, the employee started as a part-time employee and then moved to a full-time position. They were then offered a plan to their employee, spouse, and dependents that was at or below the mainland federal poverty level, so that was that $95.38 for 2016. You can use 2B code in this example as your safe harbor because you're telling the IRS, look, we didn't offer them a plan these months here because they weren't a full-time employee yet until here, and then they were in a waiting period, and then we offered them a plan. That comes to the end there, and I see a couple questions. One is, what is considered proof of offering coverage? So the IRS looks at your documents, so any documentation. If you sent out enrollment notices to your employees stating, you know, we're having open enrollment for our next plan year that's covering January to December, that will be sufficient through an electronic form. I would suggest to not only contact your employees electronically, but also contact them via paper. Show that you posted something in your employee area where you post all the other documents that, you know, you made a huge deal out of it. That's more for your open enrollment. You can also send a mailing to the employee if they're out of state. And just document that that's your business practice. What are your policies and procedures? How are you going through these processes with your employees? For a new hire, I would suggest having something stating that here's your offer of coverage, which is also kind of part of that marketplace exchange notice, but it would make it a little more individual, just as a best practice to show here, we're offering you your benefits effective this date. Your coverage is going to be from this date to the end of our plan year, unless there's a change in status that occurs, and go from there. You can have the employee elect information on a piece of paper. If it goes through a benefit system, that's fine too. All of that is reportable, and you can show that you offered the coverage. And the other question is, if the employee didn't submit any claims to get reimbursed as the HRA, and I'm assuming can the HRA amount that's put into a bucket for each employee counted? And according to 2015-87, I'm going to say yes, even if there were no claims, because there was that offer to that employee. They were eligible to use it, so that offer was there, kind of like the opt-out credit. Even if they didn't take it, it was offered to them. It's there to take if they wanted to, so it still goes on line 15 whether they opted for it or not. There's nothing specific in there about how the claims must be used. It's just that if it is offered in that manner, then it can decrease that amount. So code 2I. Code 2I is not available for 2016 any longer. So your code goes so 2I was transition relief for 2015. They didn't really continue it for 2016, even though the plan year transition relief that's very limited still goes into 2016. So if you offered a plan, this is your plan year goes from September to August. Oh, okay, and in 2015 it was not affordable. If you qualified for transition relief, you could use you can still use code 2I for January to August, as long as you qualified under the transition relief, because that was what that code was for. And otherwise, it needs to be left blank if the plan was not affordable to the employee based on the safe harbor that you chose. So just another tidbit on the safe harbors, you can't pick and choose for specific employees what safe harbor you're going to apply. So if you have all of the employees in one group, let's say they're all hourly employees, you can apply the rate of pay safe harbor to all hourly employees. And then another group, like salaried employees, you can decide to apply the W-2 safe harbor to them. That's fine. But within your group of hourly employees, you can't say, I'm going to apply the rate of pay safe harbor to Joey, Jim, and Sally, and I'm going to apply the W-2 safe harbor to Jack, Jill, and Jim. It doesn't work that way. You can only set it up for different groups of employees. So if it's not affordable based on the safe harbor you've elected for those groups of employees, line 16 needs to be left blank. Are there any other questions? You're welcome. If there's any other questions, please go ahead and type them in. If you happen to have questions that pop up, feel free to just shoot me an email on them. I'm there for you. The first question is always free. I'm only kidding. I don't mind answering questions for free. It's all good. Just shoot them over and we'll go through it and get your pieces out the door. If you need additional assistance aside from those questions, then we'll look at some project work on the side. So just let me know if there's anything you need. And I don't see any other questions coming through, so thank you so much for your attendance today and for being an Owen-Dunn client as well. And thank you to Owen-Dunn for having me.